Welcome to the stock valuations session 3, and in this session we are going to cover one important learning goal. We're going to understand the concept of market efficiency. We're going to take this concept and uh, develop basic stock valuation using zero growth, constant growth, and variable growth models. So let's begin. What are the main source of the rewards that comes from holding a stock? So common stockholders expects to be rewarded through periodic cash dividends and an increase in share value, which is capital gains. And they are normally mentioned as this is the capital gain part, and this is the dividend part. So some of these investors decide which stocks to buy and sell based on a plan to maintain broadly diversified portfolios. For instance, for income-oriented investors, those who create portfolios and receive certain income on a quarterly basis in order to run their daily chores or run their homes, requires to maintain investments in stocks which pay regular dividends. However, these stocks has to be diversified in a sense that if a firm does not pay dividend, there is enough from the other stocks to fulfill the investor's requirements. However, there are other investors who have more speculative motive for trading. They try to spot companies whose shares are undervalued, meaning that the true value of the shares is greater than the current price. Now, if they are able to identify those undervalued companies, they can buy and wait. And uh, if the and when the stock price goes up, they will sell it, and the difference will be the capital gain that they will make. Now, uh, this all depends on identifying the undervalued stocks, which is a highly skilled area in investments. So economically, rational buyers and sellers use their assessment of risk as assess risk and return to determine its value. As we discussed earlier, high risk will be compensated with high return, and low risk will be compensated with low returns. In a competitive markets with many active participants, the interactions of many buyers and sellers results in an equilibrium price. So if we draw the demand and supply curve for a stock, this being the demand curve and this being the supply curve, there's always an equilibrium price at which the stock would be bought or sold. Now, this equilibrium price is where the information about the stocks between buyers and sellers becomes same. No one has more information, or no one has less information. All information becomes equal between those who demand the stocks and those who supply the stocks. There are no price anomalies. Because the flow of information is almost constant, so stocks prices, if you have witnessed, they fluctuate a lot. And sometimes small fluctuations, sometimes big, and sometimes very huge fluctuations. These continuous fluctuations means that the equilibrium moves to a new point that reflects the most recent information available. This general concept is known as market efficiency. This means market adjust to new information almost immediately or instantaneously. So these instantaneous adjustments leads to new equilibriums at a high speed. So the market is assumed to have uh, markets are assumed to be highly efficient. Now this is basically underlying the theory of efficient market hypothesis, which says that the market is perfect or assumed perfect market in which securities are in equilibrium. Security prices fully reflect all the available information and react swiftly to the new information. So if there are hurdles to the new information, this will create price anomalies or mispricing, and those who have information, more information, will be able to benefit from that information by buying or selling the stocks. So because stocks are fully and fairly priced, it's a difficult assumption uh, to hold in practice, because we really don't know what are the benchmarks for fully and fairly priced. Investors need not waste time looking for mispriced securities. So this means that whatever price we get exactly reflects the information that is related to that security, and it's fully priced, fully and fairly priced. However, we understand that in practice these assumptions are very difficult to hold. Hence, this famous EMH, or efficient market hypothesis, has lots of challenges, and It's very difficult to prove this hypothesis in its strong form. However, there are other types that can be proved, such as weak form of EMH, which has been proved in a number of ways. The other theories, such as behavioral theories, also exist, and they also tend to explain the volatility in the market or the fluctuation in the market in a different way. For instance, regret theory deals with the emotional reaction people experience after realizing they have made an error in judgment. So if I buy a stock and the stock gains in price, I would be in as per this theory, I would be assuming that I had an error in judgment, and hence I should have hold the stock for a little longer in order to make sure that I could have benefit from this. Then there are others, which is other theory, which is called herding or herd theory. It says that some investors rationalize their decision to buy certain stocks with everyone else is doing it. So if someone who's making a lot of positive or successful trades in the market, then it's better to follow them. This herding actually leads to high prices in certain stocks without knowing what triggered it. This also means that there are certain the fundamentals of the firm does not change, but the price still goes up. Then there are people, so they have a tendency to place particular events into mental compartments, and the difference between these compartments sometimes impact behavior more than the events themselves. So if we have a negative perception due to a certain incidence with a stock, that will remain in our mental compartment, and whenever we talk about that stock to buy it, we will be we will connect the past events with that stocks, and hence it will influence or create a bias in our buying behavior. Um then there's a very famous theory which has received Nobel Prize also, prospect theory, that suggests that people express a different degree of emotion towards gains and losses. So, so this theory is actually highly applicable in our markets as well. Then you can also look at the anchoring, which is the tendency of investors to place more value on recent information. So even if the stock price changes, the set of information is the past information or success stories of the stocks are much more than the failures. The recent information, if it is a failure story, be it will be used more to make future decisions about buying the stocks or selling the stocks. So these theories also play a huge role in determining stock valuation. Let's look at the basic common stock valuation equation. Now, the uh, common stock valuation basically emanates from very basic discounting cash flow model. We already know the discounting cash flow model, but I'll write it here in the stock or common stock nomenclature, which is P naught equals to so here we know that the price is equal to the value of common stock. If you remember, in bonds, we had this as the price of the bond. Then in the numerator, these are the cash flows, and these cash flows are dividends, and this is DT, which is per share dividend expected at the end of the year T. So in stocks, we normally deal with at the end of the year T rather than beginning problems. So they are all end of year problems. Then we comes is RS. In bonds, we used to write RD, but here we are going to use RS, and RS is the required return on common stock. So let's look at the an example. The zero dividend growth model assumes that the stock will pay the same dividend each year and year after year. So in this case, we have all D1 equals to D2 equals to D3 and so on. This means we have a constant D that exists, and that first dividend will remain the same forever. It's a convenient assumption in a sense that unlike interest rates, which are known in advance, we do not know about the dividends. If the firm decides to make a dividend and what is the amount of dividend or growth in the dividend, that then it will be easier. But this is not the case. We have no idea about the firm's eventually granting dividend, how much and what is the growth rate in the dividend each year. So this is all uncertain. Hence, a convenient way of doing is to use a zero growth model, which means there is no change in dividend. The first dividend remains until the number of years that we use for the question. So it comes out that it is P naught will be equals to D1 multiplied by summation T is equal to 1 up to n or infinity, because dividends can be stock exists forever. It exists forever until the company is bankrupt. So this infinity stays there, and dividends also can be given forever as long as the firms exist. So unlike bonds, which has a maturity, dividends or common stock does not have a maturity, so we have to use the term infinity. Then we have 1 plus RS. This is required return on stock, which is T. Now this can be shortened, and the short form is that the D1 plus D1 multiplied by 1 over RS, and that comes out to be 1 over RS. So basically we have a P naught equals to D1 over RS, and this is called zero growth model. You can see there is no growth here in this, no growth in dividends. In dividends, it remains constant. So if it is $2.5, we expect this $2.5 forever to come. The company will pay always forever pay the same $2.5. And you can see that this is as much as a difficult assumption to digest. We also understand that it is very convenient in a sense that only deal with a static amount and we can come up with a price. In terms of unknown, you can also see that if we are given the price and the dividend, we can calculate RS, which will be dividend to price. Or in other sense, we can also calculate the D1 equals to if P naught over P naught multiplied by RS. So these are the different ways to calculate the unknowns as well. Now, CS estimates that the dividend of XYZ company, an established garment producer, is expected to remain constant at $3 per share indefinitely. Now, when the word indefinitely or forever comes, we understand that this is a question of perpetuity. And in this case, in time value of money, we knew that it is basically the present value equals to the cash flow divided by R. But in this case, in stocks, we just change the nomenclature, we change the variable names, and that comes out to be P naught equals to D1 over RS. So this can be calculated by $3 divided by the returns, which is given as 15%. We're not mentioned in the question here. That comes out to be $20. $20. The price is $20. $20 per share. Now let's go to the constant growth model. Constant growth model is widely cited dividend valuation model approach. It's better than the zero growth model in a sense that it actually include the growth component. How, and as far as zero growth model means there is no growth, there is zero growth and static amount. So it's better than that. It's a notch higher in the rank. It is widely cited as a dividend valuation approach that assumes that dividends will grow at a constant rate. Now we still deal with the constant rate, which is the growth will be constant from one time period to another time period. However, right now we don't have to deal with the static amount. We can add certain growth on it, but a rate that is less than the required return. So we also have to deal with another constraint, that required return has to be greater than the growth rate, or in other words, growth rate has to be less than the required return on stocks. In one way, you can understand that the firm required rate, the investor will always demand higher returns given the growth rate at which the firms is growing. So this can be put into formula, which is D naught into 1 plus G, and that comes out to be 1 plus RS. This is the same D naught multiply 1 plus G1. Now we have a growth, but growth doesn't have any subscript, which means growth remains constant. So we will have to add the next term, which is D naught 1 plus G2 divided by 1 plus RS 2. And in this case, we can go and we can build on D naught multiplied by 1 plus G infinity divided by 1 plus RS, and that is also infinity. Now you can see that we have changing growth rate 1, 2, and 3, 4 until the infinity. Similarly, we have a changing year n 1, 2 going all the way to infinity. While we have the required return is constant. Required return on stock is constant and the growth rate is constant. So if growth rate is 2%, it remains 2% in this formula. Only the number of years changes. This means the growth is constant. However, we have been previously dealing with no growth. Now we are dealing with growth. This is the one of the formula from this can be derived, which is P naught equals to D1 over RS minus G, where D1 equals to D naught multiplied by 1 plus G. So this, since the 1 plus G is constant, there's no need to calculate almost all. It's kind of a perpetuity question. So what we have is the short form, which is a common name for the constant growth model that is widely cited in this dividend valuation, is this, in which we have the same price, which we calculate dividend. Now the dividend includes the growth rate, which is constant, and we put 1 because this is calculated for the first year. And then we have RS minus G, which is the required return minus growth rate, and we already know that RS has to be greater than the growth rate. Now let's look at a couple of questions and compare it to the earlier time value of money questions as well. So LC, a small engineering company, paid the following per share dividends. These are the dividends per share that is given, and then we have a growth rate that is equal to 7%. What is the share of price of the share? Now, if you remember, we have this valuation formula, which is the R, which equals to future value divided by present value 1 over n minus 1. You can use the same formula here, except that we can change the nomenclature, which is instead of R, we can use the growth rate among the stocks, and it's the dividend for 2015 divided by dividend 2010, and this is 1 over 5 minus 1. 5 because if you draw the line, you can see that it starts from 2010, 11, 12, 13, 14, and then 15. And you can see that from 10 to 11 we have 1, then second growth, and then so on, 3, 4, and fifth growth. So these are the, let me complete it. So this is third growth, this is fourth growth, and this is fifth growth. So 5 years growth we are calculating. 1 over 5, that comes out to be um, around 6.96%, or we can say it's equal to 7%. We can use the 7% to calculate the price. So first we have to use the formula, which is P naught is equal to D1 over RS minus G, and we can see that the dividend 1 is equals to the the, uh, the dividend 1 is equal to D naught, or we can say 2015. This is 2015. So this is 2015 multiplied by 1 plus G, 1 over RS minus G, and this comes out to be 2015 dividend is $1.40 that you can see from here. Now if 1.40 multiplied by, we have a growth rate which is given here, which is 1.07 for 1 year, and then you divide it RS, which is 15%, not given the question, but it's 15%, so 0.15, and minus the growth rate is 0.07. It also meets the condition that the required return is greater than the growth rate of the firm, and the answer comes out to be $18.75 per share. That's how we use the Gordon dividend discount model. It's a very important model, and we can calculate a lot of unknowns through this as well. You can see that the same formula I can use and calculate the RS minus G, D naught. Let's look at some of the variants of Gordon dividends discount model. In other words, let's calculate some unknowns. So Gordon dividend discount model is given as price 0.0 equals to dividend divided by RS minus G, and if I have to calculate the variance, that would be P naught. So I can bring RS minus G on the left side and calculate D1 over P naught, and now I can have the first variant, which is calculating required return on stock. That will be RS is equal to dividend over P naught, and we take the G on the other side, guess plus G. The other variant could be calculating the growth rate, which is RS minus G on the other side, so it comes out to be RS, and this goes on the other side. This will be minus D1 over P naught, and on this at the same time we can also calculate for dividend, which is D1 equals to P naught multiplied by RS minus G. So these are the different variants that you can use to calculate unknowns. Now the zero and constant growth model, common stock models do not allow for any shift in expected growth rates. This is a problem because zero means no growth, so there is no possibility of a shift, and a constant growth means that the growth is remain constant during the estimation period, so we cannot shift it. Solution is to create a variable growth model, and this model is a dividend valuation approach that allows for change in the dividend growth rate, so we can shift, and we can see that from during different time periods, if the growth shifts, how would it influence the price of the stock. To determine the value of a share of a stock in the case of variable growth, we use a 4-step procedure, and let's look at each step carefully. In step 1, we find the value of the cash dividends at the end of each year dt during the initial growth period years 1 through n. So basically we divide the time period into two distinct phases. So 0, 1, 2, 3, let's say I'm just as and then we have a 4, and then it's forever, infinity. Now let's assume that we have the first 3 years marked by first growth rate, and then we have another growth rate forever. So So we actually divided the pricing based on the time period into two distinct phases. One phase is for one phase we are using is growth rate, which is represented by G1, and another phase we are using another growth rate, which is G2. Both growth rates have been estimated through different obviously methods, and so first we are going to calculate dt equals to d naught 1 plus g1 of t. So this is the first growth rate. So t from the third year or fourth year, whatever the growth rate we have been using for, let's say we are using for 3 years, so we are going to use t is equal to 3, and the growth rate will be compounded over 3 years multiplied by d naught will give us the dividend at time t. Now we find the present value of these dividends expected during the initial growth period, and to find the present value we're going to sum up all t is equal to 1 up to n d naught into 1 plus g1 t, and then we will have 1 plus rs, and that will be the t time period. This could be written in a form which we previously also wrote as a Gordon dividend discount model, but not based on the precise form. N t is equal to 1 summation all dividend dt divided by 1 plus r t. Is because dt we already in the last step was generated from this piece of formula. Next, find the value of the stock at the end of initial growth period, and which is Pn. I'll write here Pn equals to dn plus 1 over rs minus g2. Now it's a growth 2 which is included. So this is the present value of all dividend expected from year n plus 1 to infinity. So as the timeline was showing, this goes to infinity, so fourth year and so on, 0 1, and from fourth year onwards it goes till infinity. This is, here we are going to assume constant growth. So first 3 years we have G1, which is also constant growth. Then we have another growth rate which goes until infinity, which is called second growth rate. Both growth rates within the time periods are constant, but since we have separate G1 and G2, this means we have a variable growth rate over the life of pricing the security. So this comes out to be, this is the terminal value, or is the perpetuity value of the stock. This has to be, this will come at the year 4 or year 3. This has to be brought back to year 0. This means we have to discount it. In order to discount it, we are going to multiply by the term 1 plus rs over n, the number of years that we are going to use for discount it. Now remember, this could be written as divided by 1 plus rs as well, or multiply 1 over 1 plus rs raised to the power n. When we combine these two together, the step 2 and 3, we get the price of the stock, which is P naught equals to summation t is equal to 1 up to n, and then we have d naught into 1 plus g1 over t, and this is 1 plus rs, plus then we have the first thing that we are going to calculate is dn plus 1 over rs minus g2, and then we are going to divide this whole term by discounting term 1 plus rs raised to the power n to bring it back to the point 0. For this we are going to 1 plus rs over n. So this is what the stock valuation variable growth model formula is. This is how we compute it, and we have understood all these steps included in it. So this is what we call the present value of all the dividends during initial growth period, and this is what refers to the present value of stock, price of stock. So this is basically the price that comes out of it is PN, price. So price of stock at the end of initial growth year. So let's look at this example. The most recent annual dividend, that's in 2012, payment of WI Company, a rapidly growing paper manufacturer, was $1.5 per share. The firm's financial manager expects that these dividends will increase at 10% annual growth rate, which is G1, over the next 3 years. So we have G1 equal to 10%, T is equal to 3 years. At the end of the 3 years, the end of 2015, the firm's mature product line is expected to result in a slowing of the dividend growth rate to 5%. So it will be 5% after 2015. And this is the G2. The firm's required return is 15%. Let's go and calculate the first. The first step, first step is to calculate the DT, and let's do this as in the first year. Second year, we know this is a 3 years problem, and so then the first year, at the end of the year, which is 2013, and in 2013 we have the dividend, which is $1.50, and now 1 plus G, which is the 10% growth rate. Remember, this was 10%, and this comes out to be 1.10, and this dt, if we multiply d naught, 1 multiplied by 2 is equals to this, the 3, which is 1.65 cash dividend. Now required return is 15%, so that will be 1.15 raised to power 1, and the present value of dividend we can calculate, which is the 3 divided by 4, which is dt, divided by 1 plus rsd. So our first step is this, to calculate. Let's finish first step and then we'll go to the second step. So in 2014 we have the same $1.50, but this time we have 1.10 square, and that comes out to be 1.210. This will allow us the dollar amount, which is cash dividend, 1.85, and in 2015 this will be same 1.50, 1.103, and this comes out to be $2. So in 2015, or at the end of 2015, we will have a cash dividend of $2. Now let's do the second step, which is 1 plus RS, and we divide it. This comes out to be $1.43, and for the second year it will be 1.15 square, and for the third year is 1.153, and the resultant present value of dividend would be 1.37 and $1.32. Now this second step allows us to calculate sum of present value of dividend, which is equal to d naught into 1 plus g1, 1 plus rs, and this is t, and this is the sum. T is equal to 1 to 3 years. Because of this we have 3 years, and this will give us a total value of, which is also the sum of all these values, is $4.12, and the same value comes here. So we completed the first step here, and the second step is this. Now we go to the third step, which incorporates the second growth rate. In this we have n equals to 2015, which is end of 2015. Now what we do is we actually calculate for 2016. First we will incorporate the second growth rate, the G2, in this equation, which means we'll go here subscript 2, so we'll go incorporate G2 into this by doing d n plus 1, which is equals to 2016. Now in order to do this, we will be d 2016 equals to d 2015 plus multiplied by 1 plus 0.05, the 5%, which is the slow growth rate in the second or as a second growth rate of the firm. So that will comes out to be $2. This we also $2 the cash dividend. If you remember, at the end of 2015 the cash dividend was $2 in the previous slide, and then it comes out to be 1.05 multiplied by this for 1 year. So we incorporate the growth rate, the G2, into the cash DT, which is 2015, and we get the value, which is $2.10. Now this will be received forever because second growth rate stays for infinity. In order to do this, we'll take the D 2016, we divide it by RS minus G2, and this will be $2.10, which comes from the here, and then we have the RS, which is 15%, minus the second growth rate, which is 5%. So we incorporate the growth rate here. This is kind of asking for or calculating the terminal value, because this will be calculated based on the cash flows receiving forever, for infinity. So this will be the price, or PN. We can also write PN. This will get it equals to $21. Now we can use this, and as I said, we can write it as PN 2016 value. Now this we can use it, PN 2016 divided by 1 plus RS T. T is equal to 3 years, because now it's the end of 2016. We have to bring it back to the zero. So we will bring it back to by discounting it, and this is the discounting term, which is the required return. So we use the value, which is $21.00, and we divided it by 1 plus, first we added 0.15 T, which is 3 years, and that gives us $13.81. This is our third step of stock valuation. We can go and now add this present value found in step 2, which is the so step 2 and step 3 should be added together in order to get the entire price. So P at 2015 will be equals to from the second step we get $4.12 for the first growth time period, and then for the second growth time period we received the price, which is $13.81, and that gives us a total price of 17.93 per share. So these are the 4 steps that you have to practice in order to get the idea of how to calculate the value of the stock based on variable growth model. So in this slides we have actually gone through zero growth model, constant growth model, and variable growth model. The difference is that in zero there is no growth. The growth is zero. In constant there is a growth which stays forever the same, and in variable growth models we have 2 growths, G1 and G2, where G2 actually incorporates the infinity, where G1 is for a finite time period. That's for it. In the next session we are going to learn a few other models. Thank you.